We're going to run through different scenarios. So this way you know how much you qualify for depending on your income, your debt, and we're going to run different scenarios and hopefully one of them clicks in with you. So let's start off with income of $60,000 for a single person. They have no co-borrowers, right? And they have no monthly debt, no credit card debt, no car payments, no student loans, right? None of that. And then we'll start entering some information here to see how much you qualify for, right? Next is your down payment. This is your savings, how much money you want to use from your savings accounts, from your checking accounts towards your house, right? The more down payment you put down, the lower your monthly payment will be for your mortgage. And, if you put down 20% down payment, then you don't have to worry about mortgage insurance. But at the same time, we don't want to discourage you if you don't have 20%. There's plenty of loan programs, including FHA and conventional, where you can put down 3%, 5%, 10%, really depending on your savings. And for interest rates, you want to pay attention to this because the interest rates are hovering around 5.99 to 6.5. So we're going to use the higher end here. So this way we can tell you whether you qualify based on 6.5. But if you get a lower interest rate, that means you may qualify for even a bigger property. Okay. And your property taxes. Property taxes, it really depends on which area that you want to be in. Let's say you're in Queens, New York here, the property taxes might be $6,000 versus if you are in Long Island, it might be double that, right? Your home insurance, typically we see it for a single family for the whole year around $1,500 to $2,000 for a single family. So that also depends on different carriers. So you always want to shop around for that, right? And your debt to income ratio, what is that? Meaning how much money you have, or how much income you're making versus how much debt that you have, right? Including the new mortgage that you're going to take. And you want it as low as possible. You want it lower than 49%. FHA might allow you to go up to 54%. That means 54% of your income is going towards your mortgage. You don't want that because it's going to be a burden to make that payment on a regular basis. So you want your debt to income ratio as low as possible. And we'll go through different scenarios for this as well. Okay. So based on this information that we put in here, right, let's just give you a scenario, $60,000 income, which is for the year, which is $5,000 for a month. You have no monthly debt and you have $50,000 for your down payment. So you're looking at your affordability around $312,000, right? $312,000 is the price that you can afford. So with this, if you're in New York, you might be able to find a condo or a co-op, but not a single family. Single families will typically go around $500,000 or more in majority of the areas that we live in, right? So this back-end DTI, we are at 49% right now. If you want to lower, right, you want to make these payments comfortably, then you want to lower around 43%. Then you should buy a property around $269,000. This way your monthly payment is going to be around 2149, right? So if you were to go with FHA and go with 54%, then you can afford $348,000 property. Again, you can afford more now, but your monthly payment is going to be $2,700, which means that you're paying 54% of your income is going towards your mortgage, right? So now let's say you have a co-borrower that's making $30,000, right? All of a sudden now at we're going to go with 49% conventional loan. Now you can afford to purchase a house around $489,000 and your monthly payment is going to be $3,676 here. Okay. And now let's say we reduce that to 43% with both of you guys. And now you're looking at a affordability of $424,000 and your monthly payment of $3,224. Okay, and now let's say we're going to increase this to first income. Let's say the first person, primary, is making $90,000 and the second person is making $30,000, right? So with that, at 43%, $579,000, or conventional allows you to go up to 49%, then $665,000. Okay, but your monthly payment is going to be $4,901 in this scenario here. Okay, so now let's say this family here, they were thinking, great, we can find a property $665, but let's say they have a car payment now. Car payment, let's say they have a car payment of $400 per month. Now they drop from 665 to 607, right? Now let's say they have credit card debt. So we're not looking at your full balance. What we're looking at is your minimum payments. So every statement might say, hey, you have available balance of $2,000, your current balance is $1,000, and your minimum payment is $50. So we're looking at that $50 there. Okay. But now, let's say you have two credit cards, three credit cards, you're adding up all the minimum payments for each, and we're going to add that amount here. Let's say you have four of them, and minimum payments for $200 there. Now your affordability drops from 665 to 579. So around $580,000 property that you can afford in this scenario. So you can see how big of a difference it makes when you have your monthly debt here, right? And some people might say, hey, this is my second home. I don't have any car payments. I don't have any credit cards, but I do have a first mortgage. And my first mortgage, my first property that I have, the payment is $3,500. Then you simply can only afford to purchase $172,000 house, which is almost impossible in New York. So when you're thinking about your second home, right, we have to look at different scenarios. Is that a single family? Is that a two family? Will you rent out the first family and then move into the new one, right? All these different scenarios, we can offset this debt, but really depending on how you're going to proceed. What are you going to do with the second property? Okay, so let's get rid of that now. And let's just say you have $500 car payment and you have $100 minimum debt. So in this scenario, you're back to $579,000. Another scenario we want to run, let's say the primary person is making $110,000 and you don't have any co-borrower, you have 520. Then you do have a co-borrower, but only making $15,000. Okay, if it's $15,000 the second person making, then you can afford $608,000 property, and your monthly payment is going to be $4,500 there. Okay, again, we're keeping the DTI on 49% to show you, but let's say you are at 43% DTI debt to income, then you should find a property around $518,000. Okay, let's say the second person is also making around $45,000, right? And you're looking to purchase a two family in Queens, New York. And then you can afford, and you have no car payments and you have no monthly debt. You guys took care of all your debt. So when we pull your credit report and we don't see any, um, basically any payments due on that report, right? So in that case, you can afford to purchase $871,000. And some people might say, hey, in this scenario, I'm not looking for a single family, I'm looking for two family, right? So what we can use is actually we can increase the income depending on the new property that you're going to purchase, and we can add how much rental income the second unit is going to bring in, right? And we can use 75% of that income. So let's say it is $2,000 per month for the second floor that's going to bring in. We can use $1,500 for that, right? So now, all of a sudden, that two-family property you can purchase up to $977,000. Why is that? Because you're going to live on the first floor, and the second floor is going to bring in the rental income of $1,500 that we can use, but the total rent you're going to get is $2,000. Okay, so this is how people are purchasing two families in New York, and your monthly payment is going to be 7,665 in this scenario. But remember, you're going to be getting rent from that. So it will reduce your monthly obligation for that too. Okay, so let's get rid of that. Let's say you're back to single family. And now let's say property taxes. Right? They play a huge role. There are so many times people get a pre-approval and they say, oh, great, I can afford to purchase $870,000 property. But now the property that you like and your wife really likes, that property tax is at $10,000, right? So if that's the case, now your affordability drops because your property taxes are on the higher end. So now you're looking at $823,000 property there. Okay. And in Long Island, we see some property taxes are $12,000, $14,000. If that's the case, your affordability drops to $799,000, right? So we're reviewing different cases for yourself. This is your affordability calculator that you can do it yourself. Check them out on ljmortgageteam.com, ljmortgageteam.com. We'll put in the description as well so you can run your own scenarios. But just remember, keep your DTI as low as possible so you can comfortably make these payments, right? If you are able to make more higher down payment, right? Right now, all these scenarios that we did so far, we had the down payment of $50,000. But let's say you have more money in and you want to put down $90,000 or $95,000, then your affordability is going to increase as well, right? So that means once you hit 20, let's say you're going with a conventional loan, then your PMI, your mortgage insurance will get removed, once you have 20% equity. But if you go with the FHA and you're putting down 3.5%, 5%, that mortgage insurance is never going away, and you would eventually have to refinance to get rid of that. Okay? So all these scenarios we can run with you. We want to make sure that you guys understand this. And the last part I want to go over is your monthly payment, right? So first of all, let's just make sure we're good with the scenario here. $769,000 property, right? And you can afford to make additional monthly payment of $500, right? This is optional. If you do that, what happens, right? One is that with these extra payments, your 30-year mortgage turns into 22-year mortgage, right? You're nearly saving 8 years, and you're going to be saving $250,000 in your interest, right? Every time you borrow money, you're paying interest on it, right? But if you pay that off early because you're making extra payments towards your principal, you're going to be saving $250,000 in this scenario. Every scenario is going to be different, and sometimes you can't afford to make payments every month, right? Sometimes you might throw in a lump sum amount, or you might just do a monthly payment lower or higher. Whatever you do, it will help pay off your balance or your principal quicker. It will save you years. That 30-year mortgage can turn into 22-year mortgage or 25-year mortgage, depending on how much money you put down. And it can save you thousands, hundreds of thousands of dollars in your interest over the life of the loan. Okay? So all these different scenarios that we ran, we want to run your scenarios. If you have any questions, you should get in touch with us, or you can even go to ljmortgageteam.com. You can schedule a free consultation with us. We have 13 loan officers, including myself, my brother Jas here, Terlochin, Hassan. We have all these agents, all these loan officers that are ready to help. We are licensed in 8 states, which is New York, New Jersey, Connecticut, Michigan, Indiana, Georgia, Florida, and Virginia, right? So if you have any mortgage questions, if you want a pre-approval, we don't do any hard pulls in the initial stages. We want to tell you how much you qualify for. If you have any questions, please get in touch.